Let's go out there. It's October 19th. I'm Frank Curzio, the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. We're back. It's Daniel Creech Day. Daniel's favorite day of the week.
I like that. It is my favorite day of the week. Should be your favorite day of the week as well, Frank.
Yeah, it's all right. I don't know. It's not Frank Curzio Day.
Hey, we have
it's
power.
Daniel Creech Day.
We have power today. It's good. This Power Wednesday.
Yeah, very true. And also our favorite time of the year, which is earnings. A lot of companies reporting earnings.
Yeah.
We have banks that reported, probably about 50, 60 companies reported out of the 500 so far. So next couple of weeks, lots of fun, lots of news stories. See if that's driving the markets, going to continue to drive the markets. People expect the earnings to come down tremendously, but we did see very good earnings so far to some companies. And I think we have to start with Netflix, right? I mean, Netflix really blew the numbers out of the water, much better than expectations. The stock has been down tremendously. I mean, talk a little bit about that because those numbers did look pretty good, but I also dug a little deeper and, there is a little cause for concern, which we'll go over in a second. But what did you think of Netflix?
I like that. I'll take the macro and you can do the hard work there, Frank. This is not my bag. As Austin Powers would say, this really isn't my bag, baby. I haven't really followed Netflix other than the fact that I think it's an interesting stock because it's a market mover and there's so many people that follow it. We'll get into content here in a minute because there's a few things that I'm interested into watching on it. The headline number is great because they beat on earnings per share. The net ads was over 2 million. And they only, you talk about this a lot, the bar or the expectations that they set were 1 million. So that's a little bit low depending on past quarters or whatever, but that come in as a beat. The next quarter for Q4, they're projecting about 4 to 4.5 million paid net ad subscribers. That's impressive because year over year, if you look at fourth quarter last year, there was over 8 million people. So the market is looking at this and saying, hey, that's not terrible given, tough comps and things like that. The most interesting stat that I saw released on their earnings is they gave a percentage, and I don't think you saw this at first, did you, Frank? Because we were talking about this last night, and I said, hey, these numbers are incredible.
I love this metric, yeah.
And the company noted that it was measuring its engagement versus other streaming companies. And it said in the UK, Netflix accounts for 8.2% of video streaming. That's compared to 2.3 for Amazon and 2.7 for Disney+. In the U.S., Netflix accounts for 7.6%, and I apologize, I know numbers are kind of tricky to listen to on air, but Netflix in the U.S. accounts for 7.6% of streaming TV time, Amazon at 2.6%, and Disney plus Hulu Live, that's a mouthful, is 1.4%. If you are in this space, if this is your area and you like Netflix and you want to deep dive and look into this as an investment, those numbers are incredible to me. And you want to keep measuring these over time. Again, from a 10,000 foot view and a guy that doesn't follow this stock or trade it or anything, I was surprised to see that big of a gap between the streaming percentages with Netflix and its competitor. Now, maybe everybody listening to this, then their Netflix fans are nodding in agreement and saying, yeah, but we already knew that. I'll admit I did not know that, and I think that's very impressive as the leader. So if you're going to be in this streaming world or if you want exposure to this industry, talk me out of this and tell me why this is, what did you find that makes you want to step back for a minute?
I mean, we could talk about that for a minute because, Netflix accounts for 7.6%, again, of all the streaming on TV in the U.S., where Disney is 1.4 times. That number could change drastically quarter by quarter depending on what content comes out. And when you look at the content that Netflix released, it's not surprising. I guess it didn't really surprise the street, but I found myself watching a hell of a lot of Netflix. I mean, Monster Jeffrey Dahmer story, Cobra Kai, which is fantastic for anyone who grew up in the 80s. Please watch that. You would laugh hysterically. It's not necessarily for kids. There's some dirty stuff in it. It's hilarious. It's just really, really great. It takes you back there. They released a new season, Stranger Things. I think Stranger Things 4. My kids streamed the hell out of that thing, watched it immediately. So it puts a lot of pressure, and it just shows you a business model that is not broken, but Netflix found a way to make it work. They're generating money off it, where Disney hasn't found a way to work. They're losing billions and billions and billions of dollars. They have Hulu. Hulu's been around, I think, just as long as Netflix, I want to say. It might be off a little bit by a couple of years. They still lose a ton of money. I think they lost $1 billion. It's all about new content. And to get new, great content up, it's very, very costly. And then what do? You turn around and you charge well, for Netflix, it's going to be $15 with their new ad-based service. Or I think $7.99 with ad-based, $15 without. And Disney's average revenue per user is like $4 and change, right? It's much, much lower because they give away the service for free. What Netflix did say, there's a couple things that I didn't like, because the numbers were good and everyone's talking about how good the numbers are. And I love Netflix. I love Reed Hastings. You guys know that. Every time they tell that guy he can't do something, he'll do it. I mean, he put Blockbuster out of business when he was trying to get bought by Blockbuster, and they made fun of him. That guy is just an unbelievable CEO, just unbelievable for years and years and years. Now you got to the point where there is saturation now because of these numbers. People are saying, well, there's still lots of growth. Yeah, I don't know how much growth there is in terms of how much time people have. I don't know if you're going to see more growth than when people stayed home all day during COVID. I mean, it's tough comparisons. I don't think you're going to see those numbers go up dramatically, but subscriber count is good. They're going to generate more money from ads. I think it's not going to change me from going to Netflix. I still think Netflix is the best, but you look at sales outside the U.S., 55%. You mentioned this stat to me too, because I didn't see it in terms of currency. You guys know how hard I've been pushing on how that's a big deal when, that the fact that dollars are 20-year high. I think it's a 30-plus year high against the yen. But talk about those margins. I mean, when you mentioned, I said, no way was it that much of a hit. I told you how much of a hit to EBIT was Nike. I said that last couple times, earnings before interest and taxes. It turned out to be an 18%, almost 20% hit just due to currency. With Netflix, I mean, what were their margins? Was it operating margins of 10%?
They issued guidance for the fourth quarter, and they expect operating margin of 4% compared to 8% a year ago. And they said the impact, excluding the year-over-year impact of currencies, the margin forecast would have been 10%. So you have a 6% gap there, just because nothing other to do than say, hey, you're paying me here, I'm going to exchange that, and bam. Just like your story about losing 30% in your Canadian investment.
Yeah, it is.
I don't mean to laugh. That's
it.
Not
you don't
funny,
realize
it,
Dan. Until it happens to you, I'm like, holy shit. You get money. It's like, wait a minute, I invested, and now I have to gain considerably and have massive gains because the currencies went down, because a lot of that stuff that I invested in Canada is the Canadian dollar and stuff like that. That's what got crushed. But against the dollar. But you look at Netflix said they're going to stop reporting member growth. I hate when companies remove a metric that gives you a clear indication of what's going on. I hate that. It tells me that, you're worried about growth. They also lowered their guidance into next quarter, which no one's really talking about because they really blew out the numbers this quarter. So I love what Netflix did. This is one of their best content quarters that you'll see. I mean, Stranger Things, Cobra Kai, again, Jeffrey, I can go on. There's like about 3-4 other things. I found, seriously, myself, and we were talking about this, Daniel, watching a ton of Netflix with my wife when I get home. And I bust my ass at work. She busts her ass with the kids and run around and does everything and pays the bills. And, when I get home very late at night, we watch TV. And sometimes I'll watch, Chicago PD or, Special Victims Unit, right? SVU or something. But I found myself, both of us like, hey, let's see what's on Netflix. And we were watching Netflix, and now we're in certain series, which, again, this is how you have to look at it with stocks too, right? If you're really going to stream, if you're using those services, this is how you can determine if the numbers are going to be strong or not. I didn't think they were going to be this strong, but the stock was super depressed. But, and getting to Disney, which Disney is going up. Disney doesn't have as much FX exposure. I looked. So when you look at Netflix, it's 55% of sales is overseas. For Disney, it's like 19-20%, much less. So they're not going to get hit too hard with currency issues. But I can't see them putting up these numbers because I didn't see anything on Disney that makes me want to go there. They lost subscribers year over year. People don't talk about that domestically, or quarter over quarter, I think, from last quarter to this quarter. And I think they're going to lose subscribers again, unless they're giving them away for free. So, I mean, they could say, we gained 7 million. And that's what people like to hear, just like with Netflix. It matters how much you pay for these subscribers, because the one thing about Netflix that's totally separates themselves from everyone, especially Disney, is they make a lot of money off of streaming. Disney has not even come close to finding a way to making money off of streaming. Look at the cash flow numbers. That's why all the companies are lowering estimates. So if Disney doesn't beat the estimates, it should go down 20%, because the estimates have been lowered dramatically for next year, dramatically, and no one's telling you. Just like they were with Goldman Sachs. Goldman Sachs beat the numbers; it was great. And what did they report? Net income was down. Why? I think it was 26% or more.
Yeah, earnings were down big too, 40% or something like that.
Yeah, so earnings were down 40% year over year, but they beat the estimates, right? So we have to be careful here, because you're seeing some companies report. You saw American Airlines report great numbers, right? Apples comparison, but and you saw Delta record revenue, But when you're looking at some of these other companies where the estimates have come down tremendously, and then saying X currency like this is going to be a short-term issue, it's not going to be a short-term issue. As long as the Fed's raising rates, as long as it's going to be destroying the rest of the economies around the world, people are going to, all the countries are loaded with debt, saddled with debt. They're going to be pushing so much more money into the dollar. The dollar's going to go higher. This is going to be the norm going forward until the Fed actually turns around and lowers rates, not stops. We're under the impression, once they stop, it's going to be fine. They have to lower rates. Until they lower rates, it's going to be very, very dangerous for a lot of these companies where this is the norm. So you could separate this and separate that out of earnings. But, with Netflix, I think, just to show you the discrepancy of the difference of how people believe in terms of the analysts' estimates. And this is what you're going to see with so many stocks where you could drive a truck through it. Andrew Horowitz made fun of me. You can drive a truck through it. So the Benchmark company is a very good company, research company, and they provide research, right? So institutional size, their target is 162. I don't know if you know what Netflix is now. Where is it? Do you know? Like 275?
240.
Is it 240?
Well, it's up pre-market, so it's 268, give or take.
Yeah, so it's around
pre-market.
268.
Up 11%.
268. Their target is 162 after these numbers.
Wow.
JP Morgan's target is 330. When have you ever I mean, we're talking about one of the largest companies in the world here. Even though that market cap has come down tremendously, it's still the number one street from 330 to 162. I mean, think about, so that's just a target price. I wonder what in order to come to 162 and 330, you have to analyze, you have to have your model. Yeah, I'd love to dig deep into the model and see how you're getting 162 from 330. Is it simply you could have the same numbers and say Netflix should be trading at 15 times earnings compared to 23 times earnings or whatever it's trading at? But that's a massive. I mean, if you're an investor, you're going, okay, I think Netflix is fully valued. I think it has a lot of upside, not a lot of upside, a little upside on momentum. I wouldn't be buying after this quarter because, again, that content, you have to continue to pay for that content. They had an amazing quarter when it comes to content. Yeah, I wouldn't take this as, hey, Netflix is, the whole industry's back and buy Disney. I'd be very, very careful with that.
Frank,
thesis.
Nobody believes you're buying Disney here.
I'd be very, very careful. The one thing is they don't have to worry about currency, but I said Disney could be an amazing stock if they just started licensing out their content instead of doing streaming because it forces them. Now, you can't put your best content on there. Netflix puts their greatest, best new content on there. It's the only place you could look. The greatest content that Disney has doesn't go on their platform until after it goes out in the movies.
Yeah.
So it's a big difference, right? So they're tied in this, thing that they can't really figure out, and they cannot figure out, and they haven't figured out, even though people think they did, because they're just adding free subscribers, and that's all they want to look at. But the average revenue per user is one of the lowest among the industry outside of Paramount. But it is going to be interesting to see with Disney. Disney does a great job of financial engineering, and the numbers have come down. I want to say more than 15% just over the last month and a half. So if they don't beat this number by a wide margin, I'm going to be, again, they wouldn't beat the number if it was the actual number from last quarter. But the fact that it's been lowered so much and Disney's down so much, I mean, it sets up for them to actually do like they did last quarter with a lot of companies in last quarter. It's like just, report numbers, we're going to beat, stocks going to go up, and then you're going to see it go down a lot further leading up to next quarter.
Two things quickly on Netflix. I know we're spending quite a bit of time. Did you see the next quarter guidance? I want to ask you this because this stood out to me. Netflix is up about 11% pre-market. Mm-hmm. The guide for Q4 next quarter earnings per share is 36 cents. According to Capital IQ, that says that's versus an estimate of $1.22. Yeah. That's about a 70% difference from $1.22 down to 36. And yet, now is the market pricing in what you've talked about, those estimates that have to come down? I mean, how do you look at that and not think, well, that can't be good, but yet the market, hey, right now it's not popping.
So when I see that number in that low, one is it changing.
Talk about driving a truck through it, 36 from $1.
But there's a reason for that. I'm pretty sure. I mean, you have this, they're changing their business model, advertising, they're spending a lot of money, so that money is going to be more back-end loaded, right? So with the advertisers. So it matters what they're going to report for the full year. I mean, their guidance has been lowered incredibly, but that might be because they're spending a lot more money on something that they're going to make up in the future.
Gotcha. So like a one-time off, like, hey, adjusted, okay.
Yeah, I mean, I wouldn't say it's a one-timer because usually they don't include those in earnings if it's a one-timer, right? They strip them out.
Well, the adjusted, yeah.
Adjusted, or we took, like banks, we raised our for whatever, for loan reserves or whatever, or, we lost money where we're putting more money for loan loss reserves. But that number I'd look into a little bit because that number is a lot lower. And then when I see that number, I'd be like, okay, are they also lowering revenue and they're not really lowering revenue? It's 7.8 billion versus 7.98. So, so it's something within there that I would look at. But it will be interesting to see, how they report going forward. It is, yeah.
Last thing here, all you freeloaders out there have until 2023 because they're cracking down on that account sharing password stuff, Frank. So I need your password because I want to watch two things. I want to watch the GameStop saga thing. That looked interesting to me. I thought the ad they took out in the Wall Street Journal was nice. And two, A, have you seen that? And two, have you seen the John McAfee story? Is it Running with the Devil? Have you seen either one? You watch Netflix almost every night. You haven't watched either one of those two, Frank?
I didn't see that one, no.
Well, that's what I want to watch. So I'll report back.
Wait, what was the first one?
The GameStop deal.
No,
the GameStop.
They had great
story.
documentaries on it. There's great documentaries on it. One last thing here is Amazon, right? Amazon out of nowhere is 2.3%, right? In terms of, or was it 2.6% in the US, right? Where Netflix 10.6%, Disney 1.4%.
Yeah.
There's another thing that Disney could do that's very important because ESPN is in channels because it has so much political shit around it. The demand for live sports is insane. And Amazon with Thursday Night Football, and Thursday Night Football, the first two games are good. The next two games are really like the worst two games ever. But I'm sure they're going to be able to dictate those games going forward. And that's why when you're looking at the NFL ticket with Apple, I think they want to, they're working out some kind of deal where, they're probably going to get it, but there's still little things here and there. But Amazon's numbers, when it comes to live, I mean, people were streaming. Amazon said they signed the most Prime members ever.
13 million or something.
They found a way to generate money off that where you had it, so you have to be a Prime member, which is good. So you're paying for the Prime membership and you got tons of benefits and you get like one day, ship next day delivery and stuff like that. So now what Amazon showed that the model works, especially when it comes to sports, and people will watch sports for the rest of their life because of how exciting it is. It's the greatest content. It's unpredictable. It's live. That's why sports are amazing. And football is by far one of the biggest assets in the world, not just in sports, but in the world. But Amazon, if I was Disney, with ESPN, they were going to get rid of it. They were looking to sell it. Now they're not looking to sell it. If they could find a way, just stream all those games or have the exclusive where you're streaming certain games, that's going to result in a lot more viewership and people are going to watch a lot longer because they watch the whole sports game. They don't watch like one or two series. So we'll see. I mean, it is a war. I think the market is kind of saturated. I think Netflix reported good numbers. It's about content and it costs a fortune. I know Netflix has figured it out. I know that Disney hasn't come close to figuring it out, and Amazon is just now starting to figure it out. So it is going to be interesting. And look at the competition there: Amazon and Apple. Yep. Right. So the guys with the deepest pockets, something that Disney doesn't have, something that Netflix has a decent balance sheet. Disney doesn't, but it'll be interesting. So we spent a lot of time on that. I want to turn to other news, which is BlackRock put earnings. Last week? They're pretty good, but the news hit where Missouri's pulled $500 million out of pension funds managed by BlackRock because of over the asset managers' environmental, social, and governance (ESG) priority over shareholder returns. We saw Louisiana do the same thing, $794 million. So 794, 500. I don't know how many other funds have pulled it. In a scheme of things, that's $1 billion. They have $11 trillion under management. That was, I think, 6 months ago. You got to figure that's about 15% less because of the market, 20% less at least, or 15% less because they probably have, even in bonds, right? Where's it hide where that it's not down tremendously? But I think this is a very big deal, Daniel. I think this is a very big story, especially for BlackRock and asset managers. And I think it's worth consideration of talking about it because I don't know who BlackRock thinks they are or what they're doing.
Oh, yes, you do.
I mean, well, you have Coca-Cola, Nike, they have board of directors. They can do what they want. They can support what they want in terms of because they think it's going to generate more business. Nike can support Colin Kaepernick because they think that's their target market and they could help generate more sales. That's fine. If you don't like it, you sell Nike. BlackRock is an asset manager, right? We talked about fiduciary responsibility of doing the best interest for investors. And are they really doing the best interest of investors when ESG is let's get rid of oil? No more fossil fuels. You're not investing in these companies when this is the only sector that's gone up. I mean, this is legit. I mean, it's political lines. You're seeing, Missouri, Louisiana. You're seeing a lot of the red states all coming after them. This should be red state blue. This has nothing to do with politics. I mean, it does with BlackRock. It does with BlackRock. Yeah. For the asset managers, it shouldn't be political where if you're Democrat, I'm going to keep my money with BlackRock because I want them to continue to donate money for me. They are losing money. You hire them to make you money and do everything in the best interest where they're the smartest guys out there. They're investing in something for political reasons, which means that they're not doing their fiduciary responsibility, which means that if their returns are down and don't beat the benchmark, almost every state would have the right to sue them, especially since they have low, right? I mean, just the asset allocations is extremely low when it comes to energy. and other things as well. But I think this is a really serious story. It's going to get a lot more attention, but it's interesting to see how there's actual pension funds coming out and saying, look, we're out of it. We're going to go someplace else. Yeah,
attorney generals from state to state are having a field goal with this. And then on the other side, getting political. On the right side, you have them writing letters and saying, hey, BlackRock, you're not doing your duty. We're going to pull some funds. On the other side, BlackRock is in, pardon the pun, between a rock and a hard place, because then you have the left saying you're not doing enough yet. And the takeaway here is this is proof, in my opinion, that markets work. And this is why the economy, and markets, capital markets are essential and key. Outside of energy, which you literally need to keep the lights on and keep the world moving, you need capital markets because you have this tug of war pullback. To your point, on October 13th, when they reported, assets under management fell 16% year over year to 7.96 trillion. So they still are huge. They got 8 trillion under management. Mm-hmm. What's happening here, and which I think is good, and listen, you can believe anything you want. You can't argue what your fiduciary responsibility is for your clients. If BlackRock wants to get political and use their influence, like Larry Fink, CEO of BlackRock, said in his annual letter recently, that they are going to start voting and use their weight and CEOs better get in line, that's fine. That's up to them. However, you can't get upset about people pulling their money for those reasons. And now, this is on oilprice.com, BlackRock was forced, because of people pulling funds, to come out and say, listen, we are not shunning the oil and gas industry. We are not doing this. And then they tried to back it up. So it says BlackRock's role in the transition is a fiduciary to our clients. It is not to engineer a specific decarbonation outcome in the real economy, an asset manager, a spokesman said. This is good because once you get so far out of line, people can vote with their feet and vote with their wallets, and that kind of brings it back in. This is literally capital markets working and showing you how it can keep balance outside just based on money, because you have to make solid returns. These pension funds are relying on funds to keep the kicking the can down the road. Most of them are underfunded by a huge margin. Mm-hmm. When you look at it. Now, if you want to eliminate one of the, if not the most important sector, which is energy, forget what kind of energy. Energy is by far the most important. I think this is overall a good takeaway. This is a wonderful case study that'll go on for years, and we'll look back on this to see what BlackRock's role is. They're not going anywhere. I just think it's great to see states like Texas and Louisiana, no doubt oil and gas states have got to come up there and state the obvious. But I just think this is a great macro picture of capital markets balancing out, people voting with their feet and their wallet. I do think that it's wrong for them to shun oil and gas. I think when you have to come out and defend your role, it shows you were probably a little too far outside and you need to come back. Mm-hmm. This will remain to see how it unfolds. This story is nowhere near done, but where does the money flow? So think about the opportunity. You're another asset manager. There's already been ETFs that are anti-woke. We talked about the inverse Jim Cramer ETF in the office. There's an inverse Cathie Wood technology, ARK Invest. You can do it. My point is that money's going to flow where it's treated best. That's a great story that everybody needs to grasp on. And I just like to sit on the sidelines and think this is great. I'm bullish on oil and energy, so this is just more fantastic for me.
I mean, it's an easy solution, right? I mean, and we're talking politics. We're going to get into politics too, the strategic oil reserves, being released, and get into that with Biden in a second. But it's an easy solution. I mean, BlackRock could start their own ESG fund that is dedicated just to that. And if investors want to check that fund, that's fine. But when you're checking BlackRock and you're checking their funds, and it's being managed to the point where you have to be politically correct. And a lot of that politically correct stuff has to do with donations and payouts and bribing, which is basically what lobbying is. It's just bribing. That crosses the line. But, if you're not seeing returns because you're not in oil in some of their biggest positions or whatever they're in, different funds, that's major. You could argue. You could argue that you're not doing what I hired you to do, what we signed in our contract. And I think that's what you're seeing here. And now we look at the strategic oil reserves, which is amazing. But, listen, in all fairness, Biden said he's going to announce they're going to release 10 to 15 million barrels from Strategic Petroleum Reserve, SPR. I mean, it is exactly what he said he was going to do in terms of how much. They're right in line here where it said they released 160 million barrels from the SPR out of the around 180 million that they said they were going to release, I think, in March. So they're within that. But I mean, it's getting crazy right now because when you throw this in and the timing, right, and how much it is, when it was $1 million here, now, I mean, this is a big amount right before the election, right? We know that. We get it. We understand. And almost every single president has done this, not to this extent and how much when it comes to the SPR. But the European Union embargo on Russia, right? That's scheduled to go into effect on December 5th. I think it's December 4th. OPEC is meeting again. What do you think that they're going to do? I mean, now the U.S., not only did Biden try to go there, which I think it's funny because just the people who are pulling that guy's strings, I think everyone's aware that the guy is just out there. But even the Democrats, or whoever's running it, they're throwing him completely under a bus, just saying, just tell him to do this, tell him to do that. And I mean, and it's getting crazy now. And it's just some of the things that you're doing that we see like from a mile away. Okay, you're not doing this for the better country, you're doing it to get votes, right? And we see that. Releasing prisoners from jail and stuff like that. It's just, there's so many measures here that are getting crazy. But you just tried to convince Saudi Arabia to say, hey, you know what? You have to be on our side here. We're releasing more oil reserves, stay the same, don't cut or whatever. And Saudis basically gave him the finger and said, you're doing what's in best interest for your country. By releasing all this oil, we're going to do what's in best interest in our country and keep oil prices higher. And then after this happened, the U.S. current administration started attacking them. Oh, we'll tell them. We told them, this is what we're going to do. This is what you're going to do for what? I mean, you can't do anything to Russia. You can't do anything. This is what happens when you have your own energy. What are you going to do? And the fact that you're threatening them at this stage, when they're coming up with another meeting, who knows? Is it going to be another cut in production? Is it? Why wouldn't they? I mean, it's kind of crazy where you think the oil dynamics, where as long as we don't have this incredibly deep, massive recession, it looks like oil has to go a lot higher. However, we are seeing demand getting curbed a little bit. And it's interesting. I want to get your thoughts on it. I know you love oil, but you just think oil is going higher no matter what, right? Especially when you look at this dynamic, and I know a lot of people talk about it. It looks like oil is going a lot higher, but I think you have to factor in with, look at the drop off every place, right? Yeah. Where you're not going to see as much building. Housing starts we're down much more than expected. That number just came out as we were talking, down 8% compared to I think it was 6% was a number. You're going to see construction come down. You're going to see all this stuff come down, which, again, it's hard for me to see. It looks like oil prices are going a lot higher, but there are headwinds out there in terms of the macro view.
Demand destruction is definitely a worry of mine as the recession and or large recession and or depression kind of unfolds. So yes, I'm constantly reading, as Charlie Munger said of Warren Buffett, I am sitting on my ass and reading a lot, Frank, to try to figure out where I'm wrong on this. Oil is about $84 a barrel right now for us on WTI. It's about 91-ish on the world markets. Frank, the White House put out a fact sheet. Now, we're going to have to talk quietly here because we don't want Saudi Arabia to listen. The fact sheet about the SPR release and all that. Do you know where we are planning as a country to buy back our oil to refill those reserves?
Is it Venezuela?
No. What price? I'm sorry. I set you up for that.
I think I saw that yesterday. They were looking at, was it in the 70s?
67 to 72. The White House put out a fact sheet that I'm reading off of right now, and they want to repurchase crude oil for the SPR when prices are at or below $67 to $72. That's roughly 14% lower on our stock. On our price, WTI. To your point, how does oil get there if, let's say we have a huge demand destruction, major recession or depression, whatever you want to call that. I don't think the language is important there. If you're OPEC, how do you let that go? I just think there is a unfolding of new alliances being made around the world, and we'll talk about that over the upcoming podcast, because I think that is going to play a huge role in the energy and everything else. To your point, yes, I'm bullish on oil because there has been a lot of underinvestments for several years in oil and gas. And basically, and I was talking to you off air, I don't know if I've mentioned this on the podcast yet, but Kyle Bass did an amazing interview with Will Van Loo or Van La, I'm not sure how to say that, from Quantum Energy. Mm-hmm. And they have some amazing stats. It was earlier this year. But we are basically in balance at 100 million of production and 100 million of demand per day. But we're going to use more oil this year because we're back to pre-COVID levels on the demand side versus what we produce. Now, that's not saying, hey, that's a huge imbalance supply-demand. It's not rocket science. It's going to go up. There's a lot of components within that. However, pre-2004, I told you this, Frank, pre-2004, there was over $700 billion a year being invested in capital expenditures for oil. The last 5 years, that's been under $350 billion. Now, that by itself, again, that doesn't mean, oh, goodness, oil's going up no matter what. But when you factor in logistics, alliances, price caps, you go back to 1970, Richard Nixon came out and actually said something intelligent when inflation was running high. And he said, listen, price caps are not the way to go. That's only going to make the problem worse. We're not going to implement those. In 1971, for everybody listening out there that doesn't follow numbers well, that's a year later, he said, we're implementing price caps and everybody has to do price caps. And that's why inflation continued to get worse. Price caps are being talked about right now in the European Union, all over the world. America seems to be pushing that. Secretary of Treasury Yellen is backing that for some reason. Anyway, when you add all these components, that's why I'm very bullish on oil, despite a slowdown of somewhat demand destruction, because you're going to take oil and supply off the market, and you have other countries like India. I believe India is going to pass China as the most populated. I think that's going to happen within a year, if I read that right. Mm-hmm. They've come out and said, hey, it doesn't matter what you guys do on sanctions. We're going to buy oil because why? They want to increase the livelihood of their people, their whole civilization, and you need energy to do that. The whole idea of $67 to $72 to refill these and release even more, I don't know why you would show your cards heads up. Email me, Daniel@CurzioResearch.com. I'd love to know where I'm wrong and what you think about this. I don't blame them, for the Democrats, for doing this as the upcoming election. You want to try to get gas prices lower because people vote with their wallets. I understand this from the political side. What I don't understand is how the administration can put in writing a fact sheet out to buy this oil back. And what they're trying to do, if you read through this fact sheet, Frank, which I did for everybody else, so there's no need to, they're trying to explain and use the angle that, hey, we're telling producers there's going to be demand at 67 to 72. So go ahead and produce. And they tell, hey, we're going to do 12 million barrels a day. We're going to increase that by 1 million barrels a day. Mm-hmm. Frank, 180 million divided by 12 million is 15, if my math is correct. Mm-hmm. So you are telling producers, listen, Frank, you're a producer. I'm the SPR. I'm the government. You want to go ahead and increase production because I'm going to buy it at 14% less than where it's trading right now, and I'll buy 15 days worth of production. Mic drop. That makes absolutely zero sense. That is why you want to have exposure to oil and gas going forward. Last thing, I'm sorry about the rant. Baker Hughes, oil and gas services company, reported this morning. I'm not even going to go into the details. They beat on earnings per share, missed on revenue slightly. The takeaway here from their press report was, we believe the fundamentals remain supportive. Granted, they're biased. They're going to tout oil and gas because they're an oil and gas company, so take this with some salt. We believe the fundamental remains supportive of a multi-year upturn in global upstream spending, and that elevated natural gas and LNG pricing remains constructive for future FIDs. That's future investment decisions. When you talk about multi-year upturn in global investing, that is great for oil and gas services companies. Schlumberger reports later this week. I believe Halliburton reports next week. I would keep those on your radar. I think those are good trading opportunities around their earnings. I know Baker Hughes is up a little bit today. I think it's 3% last time I looked. My point is that you can email me and tell me to shut up, and you can mute me once you have exposure to oil and gas, Frank.
And I love that. Great analysis there. You look at the oil service companies and you think that they would really be kicking ass, right? So Baker Hughes, Schlumberger, Halliburton.
But the stocks have gotten hit.
I mean, look at these names. I'm looking at the last 12 months, Daniel. I mean, here, let me see if I can bring this up here. If you're looking on a YouTube channel, I like to bring up charts and stuff like that. This is an ugly CNBC chart, but it's okay. You guys will get it. I like to use free sites and bring it up right away. I'm trying to, let me see if I go just 1 year. Okay, so if you're looking at 1 year, if you're looking at Halliburton, Baker Hughes, Schlumberger is up 27%. For the past 12 months, you're looking at Halliburton only up 17%, right? I mean, look what oil is. I'm talking about the past 12 months. And yes, it went to 130, and we saw in June, a lot of these oil companies went up and then came down, but we also saw them, rebound, right? Not all the way back, but rebound. And then you have, Baker Hughes down 10%. Down 10%. And I remember analyzing this like a couple months ago because I was so surprised. I know they have exposure and had a lot of cost problems and stuff like that, international. But when you're looking at just the main fund, right? So if you're looking at the main fund here, which is XLE, is up 43%. I mean, significantly outperforming these guys. So, I mean, this might be an area that makes sense. If you think oil's going higher, one of the areas that we recommended in one of our newsletters is the deep oil drillers, which have gotten annihilated. They were filled with debt. But if you think oil is going to stay above, I mean, right now they're making money. They can make money. But if you think it's going to go higher, 90, 100, I think, oil services, and because the producers have done well, natural gas producers, Continental, we saw the buyout by Harold Hamm, buying it himself. By the way, they didn't require a shareholder vote, which, because he owns so much of the stock, so he could have did whatever he wanted. I don't know why he even paid a 15% premium. He should just said, I'm going to buy this at a 30% discount, and there's no vote because he owns the majority of the stock. So it didn't matter what anyone said. But I think look at the deep water drillers. I think that's where you could see, a ton of alpha if you think oil is going to go higher. And also, the Halliburton, Schlumberger's and stuff like that. I mean, Schlumberger is up 20%, pretty much outperformed the rest of these guys, when it comes to Halliburton and Baker Hughes. But, I would look at Halliburton. I mean, look at the names, right? You want to separate yourself and just say, hey, you get exposure in oil and buy Exxon or whatever. That's the XLE. I think it's 40% is Exxon, of that fund is Exxon and Chevron. But it's what's going to separate. Do I see natural gas going higher? Who has exposure overseas when natural gas prices go higher? I mean, there's lots, who are just as oil services companies? Because like you said, with CapEx, now they're going to start ramping it up, right? Because they changed their mind. At the beginning, these guys had a cut because the president of the United States, before he got elected, said, if I get elected, no more fossil fuels. We know that's impossible. But if you're a CEO of an oil company, you're like, we need to freaking cut back right away because we're not going to be able to drill. They're not going to let us drill. Right now, we have a whole energy crisis, especially in Europe, which you were talking about too. Just not online how, if you want to mention that really quick too, I think that was interesting in terms of we look at oil and say, oh, you can make money as an investment. I mean, this is extremely dangerous for Europe right now. We're talking about not having power during the winter where it's very, very cold. And
I'll be able to report back on this next week. I'm having having dinner with a friend from Germany this weekend, so that'll be fun to talk about. I was reading that their natural gas storage facilities are about 90 to 93% full. I took that, assuming so and being wrong, because I thought that would make them through the winter. Turns out that won't make it through the winter, but they're already worried about 2023 winter. That just means this is a prolonged thing. To your point, real quick, Frank, the XLE is up. You're right. Exxon and Chevron make up about 40% of that. Exxon by itself is up 60% over year, not year to date, but year over year. And I think you're right to look into oil services. I'll continue to look at why I'm wrong, but just have exposure to the industry.
Yeah. I mean,
Exxon got an upgrade this morning.
Yeah.
So did EOG, which is also an XLE.
Too, and one on this is, the S&P yield is 1.8%. And you can say, why even bother when you look, and now the 4 years up to 4.5. So even though the market's going up, you've seen the 2 year, it's telling you 2.5 and 10 year above 4%. It's not good, right? With this, and we've seen these bear market rallies and they get extreme. It doesn't mean it's a bottom. This is normal. It's not normal to see 10-to-1 ratio up to down, which we saw 2 days in a row. But now you can get paid a nice dividend. It's hard when you're a consumer staple or whatever, where you're saying, okay, the economy could get worse. Are oil prices really going to come down a lot from this level? I don't really see that. Maybe they don't have the upside that so many people believe and a lot of people predicting and have the stats to back it. But I don't see it coming down as much where, the Exxons, the Chevrons, that dividend, at least you're going to get paid a dividend. They're going to be printing money. Profits are going to be surging going forward, at least over the next couple of years. So those are interesting plays where in a market that's terrible, yes, you could buy those and hold those and they might get hit, but I don't know how much you're going to get a hit, especially when you have a lot of momentum in oil prices going higher. So it is interesting, but those dividends are definitely safe now. So, Dan, thanks for doing so much work on the oil part. I know that we're going to come up with a lot more recommendations for oil going forward because it's just, we're doing a lot of research in it, and I appreciate that. But guys, questions, comments, feel free to email me. I'm here for you, frank@curzioresearch.com. Daniel, what's your email?
Daniel@curzioresearch.com. All
right. Any plans for coming up this weekend since I'm going to be away?
Yeah, I'm going to play golf and then have a fun dinner planned, like I said. So need some help on the golf game. It is worse than the markets right now.
Isn't it weird how quick it goes in and out? It's so crazy. You can be really good. That's why I love it. It's just so competitive, but it's awesome.
It is the greatest game, but it sucks.
Yeah, I will report back to you tomorrow with a podcast, guys, but I am going away from Thursday to Sunday, my wife's birthday, and I'm taking her to Vegas. So it should be pretty cool, having some fun. But again, questions, comments are here for you, frank@curzioresearch.com. Dan's here for you as well. Really appreciate all the support. And I'll see you guys tomorrow. Take care.